This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Massar and Tim Stenovec from Bloomberg Radio.
So we just talked with the team, right, Tim, about KBW Bank Index down almost 4% at its lows today, still down about 1.3%. So we've definitely bounced off the worst levels of the day. Same thing for the S&P Regional Banking ETF. We're talking about the KRE, which was down about 4.5% at its lows, now down about 1.25%. And of course, this was all following Moody's lowering its ratings for 10 small and mid-sized lenders and talking about downgrading maybe some other firms. So a lot going on, reminding us that maybe we ain't out of the woods yet when it comes to banking here in the U.S.
Yeah, I think that's certainly fair to say. The concerns are higher funding costs, potential regulatory capital weaknesses, rising risks tied to commercial real estate. Those are among the strains that are prompting the review. That's according to what Moody said late yesterday. With more, very pleased to have with us Bloomberg Intelligence Senior Analyst for U.S. Regional Banks, Herman who joins us in the Bloomberg Interactive Broker.
We actually call him King of Regional Banks. I didn't know if you know that, Tim.
Was he anointed king in March? Is that what happened?
The coronation happened, yeah.
Okay. King of Regional Banks. I'm sorry, sir. I bow down.
You got to get the title right.
Well, it's good to have you. I was nice to get to meet you a little earlier, too, in person finally, because I was gone for the regional bank crisis, but I guess right. I get my own little mini crisis
you
here.
You do. It's our gift to you.
That's the question. I mean,
you're getting the aftershocks.
So to what extent is this tied to what we saw in March?
Yeah, I think it's double-barreled in terms of the fallout from the banking failures from SVB, Signature, First Republic, and also it's the aftermath of the higher rate environment that we're currently operating in. The Moody's reports noted the higher funding costs, as you articulated. So that's really crimping the profitability of these banks. And also you're seeing a tougher regulatory environment. The Fed is already proposing tougher capital rules and expected to offer some tougher liquidity rules for the regional banks. So these are all things the banking space has to contend with, and the upshot is just weaker earnings and weaker first line of defense against the expected potential higher charge-offs from commercial real estate.
It's a little puzzling to me because, and I mentioned this on with our TV colleagues a few minutes ago, this shouldn't surprise anyone.
Right. So it shouldn't surprise.
We've been talking about the struggles in the commercial real estate market for months,
right,
and rates have been high for better part of a year.
Right. It shouldn't surprise folks. We've been writing about all these issues ever since April and May. So it's been on the radar screen of all the folks that cover regional banks and write about them on a daily basis. I guess it's just more of a recall that the stocks have rallied a bit ever since the May time frame, and this is just a call that's saying we're not totally out of the woods yet, but in my view it does seem like the issues facing the banks that Moody's articulated should be pretty manageable.
All right, so March, April, May, June, July, August, almost 5 months. 4 or 5 months later. So I don't know, how do I have mixed feelings coming if I go back to the great financial crisis and when finally the ratings agencies kind of caught up to all that ailed us.
Right.
So how are we as investors supposed to kind of be like, wait, is most of this still priced in?
Right.
Or is it just, again, like you said, hey, whoa, slow down a little bit? Like how do you read a call like this?
I would just go back to some of the clients that we've talked to today, and they've mentioned that there isn't really anything new in terms of the call, but it's just reiterating the fact that there are a number of issues and hurdles and headwinds that the banks need to contend with going forward for the next 6 months, a year, 2 years.
What are the banks that you most specifically keep on your radar? I think about, and just to kind of give you some background, Tim, like I feel like we were leaning on Herman constantly during the regional bank crisis. And what was interesting is I felt like it was a few names that kept popping up. Obviously right. Silicon Valley Bank and, kind of the ones that really were on everybody's radar. But there were others, whether it was PacWest, and obviously we know what happened there, but
right.
What are the ones you now keep on your radar, either out of concern as possible acquisition targets or what?
Right. So really, in terms of acquisition targets, the only bank that really is immediate on the radar screen after the PacWest announcement is Home Street's HMST is the ticker, Bloomberg wrote about them potentially shopping themselves a couple weeks back. So that's the one that's still sort of floating out there. But the others that were potentially, tougher, hit a bit harder during that banking turmoil earlier in the year, like a Western Alliance, they've actually done a really solid job of shoring up their balance sheet and improving their capital ratios, improving their deposit base. So not expecting anything there going forward, because I think they've laid out a very credible path of regaining that balance sheet strength that they lost a bit in March.
What's a little surprising to me, Herman, is that in the S&P 500, regional banks are down 1.2% as a whole, but diversified banks,
right,
the huge ones, the JP Morgans, the Bank of Americas, those are down 1.1%.
Right.
Is it connected? Is it related? Why are they getting hit too?
I think it just shows the fact that there are headwinds across the group going forward. The capital ratios issue and the tougher regulatory environment is something that all of the banks, the largest banks in the United States and the regionals, will have to contend with varying degrees. And we're actually not sure yet.
City's down 1.5%. JP Morgan down about 2/3%.
Down 2%.
Yeah, and off their lows, but nonetheless, right? These are the ones we think, okay, we should be okay.
Yeah, that's right. They should be fine, but we're just in sort of some uncertainty involved in what's going to happen next in terms of how these capital rules really shake out.
Is the real estate exposure still a big deal? Like, what's the top of mind? Is it the interest rate exposure? Is it real estate, commercial real estate, office real estate? What is it?
Over the next couple quarters, it will continue to be the deposit costs and how fast they rise, and the mix of deposits. Will they continue to remix into higher cost forms like CDs? So that's the earnings pressure that banks are facing. Over the next couple years, you're going to see commercial real estate become more and more of an issue. Everybody's talking about it now, but the actual repercussions of credit losses really hasn't shown up yet at all for the regional banks.
Because the loans aren't due yet?
Because the loans aren't due yet, and they can do a little bit of restructuring and kick the can down the road, that sort of thing. So there's some maneuvering that's happening and some tough conversations that are going on today, but the actual losses just haven't hit. So that's going to take some time to really happen for the industry.
What do the data tell us, and what do you have at Bloomberg Intelligence that shows where people are keeping their money right now? Because if they're keeping their money in their traditional quote unquote checking account, it's paying nothing.
Right.
But you can quickly move it to one of these neobanks, and this was the problem during the March banking crisis. Everyone was like, wait a second, if I can get 4.5% over at whatever, American Express or Wealthfront or whatever, name the neobank here, then I'll just take all my money from my checking account there. Is that still an issue for the banks?
That's happening. So the longer we're in this higher rate environment, the tougher it is for the regionals, because inevitably your customer base will start to erode from the traditional checking accounts, and quarter by quarter, month after month, you're going to see those zero cost deposits continue to move to a higher cost rate, like a CD or a high yield savings. So that's something that frankly, the regional banks would love to see rate cuts, potentially later this year or next year, just to stem that tide.
We bow down to the king. Herman Chen, thank you so much. Senior Analyst for U.S. Regional Banks at Bloomberg Intelligence.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
In our Bloomberg Plugged In segment today, we wanted to get into Tesla's new chief financial officer, who's actually kind of old when it comes to Tesla.
He's like the chief accounting officer also.
So 2 pretty big jobs now on his plate, huh?
Yeah. Well, like I said before, Elon Musk has more than one job. So it's like if he's the leader and says, okay, well, I can be CEO of all these different companies. Then
why can't you do a couple of jobs?
Why can't you do a few things, right?
All right. So let's get to it, because there was some news yesterday that Tesla was replacing its current CFO, who was in the job for 13 years. So tracking it all for us, making sense of it, is our own Bloomberg News senior technology reporter, Dana Hull. She is on the phone in San Francisco. So Dana, it does feel like, first of all, backdrop, a fair amount of movement in the executive suite at Tesla. Give us a little bit of background here.
Yeah, so when we say executive suite, there's really only 4 people. There's only 4 named executives on Tesla's website and in their regulatory filings. And of the four, the CFO is one of them, and Zach Kirkhorn had been at Tesla for 13 years. He'd been promoted several times internally, and he became CFO 4 years ago. And Zach is really the person who kind of led Tesla to profitability. He focused a lot on costs, on expanding margins, and it was under Zach that the company kind of like steered through the pandemic, joined the S&P 500, saw its valuation soar. I mean, he is really beloved by investors. So something happened, and on Friday, he basically stepped down as CFO. His replacement is an internal candidate, Vyabhev Taneja. I'm butchering that name. Apologies.
It's okay. We're all trying to figure it out to make sure we get it right. Yeah, fair enough.
But then we didn't learn about this until Monday via regulatory filing. So, I think broad strokes, a lot of us are still trying to figure out what exactly happened with Zach and why he left. But we do have a new CFO who's, in the job now, but he's also still the chief accounting officer. So to Tim's point earlier, Musk doesn't really think much of having more than one job. He's running 6 companies himself, but it is unusual for a company of this size to have the CAO and the CFO be the same person.
Is there any concern about a conflict of interest with the person who sort of signs off on the, accounting docs versus the financial docs? I mean, there is a close relationship between accountants and, chief financial officers, but at the same time, isn't there good to have some sort of independence there too?
I would think so. I mean, I haven't heard any investors making a huge cry of this. I mean, that would certainly be a concern that I would share, but
who are we?
But I think the broader concern is that CFOs typically have pretty broad operational experience in the business. Like Zach Kirkhorn worked at McKinsey, he studied engineering at Penn. He had been always on the finance team at Tesla, but was just very much in the weeds about how the company was running. And the new guy is more of an accountant's accountant who came up through PricewaterhouseCoopers. And so it'll be interesting to me to see how long he stays in the CFO role.
Dana, we just learned about him yesterday.
I know.
This is flashbacks to 2017 Tesla. Remember that when it was every day there was an executive turning over?
Mm-hmm. Yep, I do remember.
Because you were the one breaking that news. That's how I remember.
Yeah, and this was a surprise to me. I mean, it really had seemed like Tesla's bench was pretty stable. Musk was focused on Twitter / now we call it X. The company has just had quarter after quarter profitability. So the bench at Tesla actually seemed fairly stable. I was not expecting a Zach departure this summer at all.
Is there something about the new CFO and his connection to India that maybe makes it make more sense? I don't know.
I mean, Tesla obviously has a lot of markets to expand into. India has always been top of the list. All of South America, another possibility. And we've always been trying to figure out, is Tesla going to enter the India market? His name is on a filing in India around creating some kind of office there. So he probably has been involved, but I wouldn't read too much into that.
Right.
Okay, well, sorry, Carol,
No,
go ahead.
No.
I was going to ask about the backdrop here. If we zoom out and look at Tesla as a company and where it is right now, obviously it's come a long way, Dana, in the years that you've been covering it. But at the same time, despite all of its successes, it's still kind of clawing its way to being really sustainable. I mean, look at the way that the company has still dealt with recalls, production delays, and that old Cybertruck that still isn't on the streets.
Yeah, I mean, I think it depends on what you mean by sustainable. They have plenty of cash on their balance sheet, and they continue to be profitable, but they certainly have cut prices in order to move metal, and they don't have a truck. And I mean, Americans really like trucks, and so the longer it takes to get the Cybertruck out, the more competitors like Rivian have time to kind of really own that market. And, I mean, Elon is sort of famous for introducing products that then take years to bring out. We all thought we'd see the Cybertruck this year. Now we kind of learned during the last earnings round that the only ones that they've made are release candidates. So, I mean, we're still pretty far away from anything like high volume production.
Forgive me if we already talked. I don't think we did talk about this, but I mean, Kirkhorn. I want to go back to him for a second. He walked away with about almost $600 million, and so as CFO. But
did you not get that out of your first job, Carol?
no, not
Okay.
even close. But that's okay. Different worlds. But I mean, could it possibly be, Dana, that he walked away from the CFO job just because, all right, I'm set, I'm good, like I'm going to do something else? Or could he be ticked off that, meanwhile, what is Elon worth? Because the stock has just taken off in the last decade.
Well, there's always there's this sort of joke among Tesla executives and employees that working at Tesla is like dog years, right? So like 1 year at Tesla is like 7 years in a normal company. So Zach put in 13 years, which is this magnificently long run. And, I think he's about to turn 40. I don't know his exact birth date, but he's like he's like 38 or 39 on the cusp of being 40. I think that, I don't know how old you guys are, but when I turned 40, that was a big moment for me to kind of take stock of my life. And to your point, he has done a lot for Tesla. The company is in a good place financially. He's still very young, and I could see him taking on another job at some point as a CEO. I think he's got the chops to do it. And so there's a lot of theories as to why he left, but I don't have anything solid to share at the moment.
I'm sure those are things you're still chasing at this point, Dana. So
always chasing.
Always chasing. And you know what? If you know why he left, you know how to get in touch with Dana. She's on the platform formerly known as X as well. But I don't know, not much Dana anymore. I'm not.
Well, one thing I wanted to ask you, we just got about a minute left here, Dana, is I do wonder, like you just said, you turn, as individuals, we turn a certain age and we do sometimes take stock of our lives. And is there somewhere where Tesla, which has really, had the field to itself for a long time, and now there's a lot more competition. We were talking earlier with Rivian earnings. I saw 2 Rivians this past weekend. I have not ever, I think, seen them on the road. So it's like, I feel like all of a sudden they're out there. There's more competition for Tesla. Is Tesla kind of maybe taking stock a little bit of kind of where its world is now and kind of where it needs to go in a very different environment from where it's been the last decade or so?
Yeah, probably. It's I think for so long Tesla was all about proving to the world that it could make a profitable electric car that consumers really wanted, and they have done that. They have proven that, and now they're expanding. They're building a new factory in Mexico. They're going to come out with the Cybertruck and the next generation vehicle platform, and they've kind of they're done being this kind of like scrappy startup. They're part of the S&P 500 now. They need to sort of mature as an organization. And I think Zach has a lot of institutional knowledge that's kind of going out the door. But his successor also has a lot of inside knowledge. So it's not a dramatic change. But the CFO is a big deal. It's a big deal for a company like Tesla.
Yeah, and as you said, the executive suite, really only 4 people. So it's, again, some perspective. Hey, Dana, thank you as always. Bloomberg News senior technology reporter Dana Hull on the phone in San Francisco. Shares of Tesla, by the way, up 102% so far here in 2023.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
You guys talked about Zoom yesterday, right?
Yeah, if you think about perhaps the company that most epitomizes working from home, it's Zoom. It was not just a COVID stock, but it was also what we were all learning how to use in the early days of the pandemic, right? We talked about it yesterday because even they're telling employees to get back to the office,
Wait,
Carol.
what?
Yeah, I know. Zoom. If you live near a Zoom office, you got to come in a couple days a week. So we've seen Amazon, Chipotle, BlackRock, companies as varied as those telling, hey, workers, hey, you got to come back to the office.
Yeah, it's interesting, right? We're seeing that post-COVID several years out and how that is kind of, they're coming back to the office. The other thing at play, right, we see when it comes to how we are working going forward is just the explosion of what the think about AI, around artificial intelligence, generative AI, and what does it mean eventually for work?
Well, fortunately, McKinsey is out with a new report that says 12 million workers are going to move into new lines of work by 2030. I guess I'm not saying fortunately. Fortunately, there's a report.
Yeah.
We'll see if it's fortunately or unfortunately that AI is forcing people to move to new lines of work. Very pleased to have with us this afternoon Kweilin Ellingrud, partner at McKinsey Global Institute, joins us via Zoom from Minneapolis, a director and senior partner at the McKinsey Global Institute. Kweilin, how are you?
Great to be with you today.
Well, it's great to have you join us on this. So, when did you guys start thinking about the impact of AI on workers? Because I think for a lot of people, this is a relatively new phenomenon with the explosion of ChatGPT last fall.
Absolutely. We've been thinking about the future of work now for about a decade and modeling what does automation do to jobs, which are biggest gaining jobs, losing occupational categories. And then to your point, just about 6 months ago, started to layer on to automation and COVID-19 impact, the impact of Gen AI. So now we've put all of those three things together to say, what do the future of jobs look like in the United States?
All right, so play it out for us. What do they look like?
I am a robot.
Absolutely.
Yeah, I'm a robot.
Indeed. I think the bottom line is about 30% of the activities that U.S. workers do today could be automated away by the end of 2030, so over the next 7 years. And that, again, is through automation, COVID-19 impact, mostly affecting interpersonal interactions, and then Gen AI. Gen AI alone, if you just isolate that piece, increase that percentage by about 8 or 9%. So up until about 30% of overall activities. There are a lot of jobs that will be fewer in the future, and there will be quite a few more. Overall, I think it's good news. To your point earlier, we will have more jobs in the future, I think is the great news. And those jobs will be higher paying jobs. They will be also higher skilled jobs that on average require higher average education. The tough news or the tough transition to get there is we don't necessarily have the workforce today that is best suited for those jobs of the future. So first, where are we gaining? Where are we losing? We are gaining jobs in healthcare, in STEM categories, and in transportation, delivery, all of those other areas. We are losing jobs in primarily 4 big occupations, and those 4 occupations make up about 80% of the job losses between now and 2030. That is customer service,
Okay.
Food service and sales, production or manufacturing, and office services or assistance. And you've all seen kind of food kiosks at fast food restaurants, right? We've seen all of these different elements, but when you add them together, those 4 occupations make up 80% of the occupational switches, which is about 12 million of them between now and 2030.
So before we get into that, that's a lot. But I've also seen it. I've done it, right? I'm at a airport. I order on an iPad and then stuff just gets delivered. I've gone to a retailer here.
I'm sorry, but
What?
You and I have done this before.
And sometimes it works.
It's also just terrible.
It's not all the time.
Maybe I'm just thinking of Newark Airport. I don't know. No offense.
Oh, come on.
I know.
Pick on the New Jersey.
We've had some fun times there.
We have.
But
it kind of works.
God, I don't know.
It doesn't always work. It's like not
It doesn't always work.
But I'm amazed at that. I think how many times I check out at a supermarket, I go there, a Target, a retailer, Zara. You go to Zara, you drop it in a bin.
That's amazing.
It shows up. That blows my mind. It shows up on
I think H&M or Uniqlo does that too. It's amazing.
Do they?
Yeah.
And you check out and you take off the safety, what do they call them? That, you know what I mean?
The anti-theft things.
The anti-theft things. Like, I do it all. And like somebody's watching you, but it's like, whoa. So I don't know.
Is the experience better though? That's the thing. Like, speaking of airports, we've done this, we've gone to airports together where there's nobody to actually check us in, right? And we're like, we know it's because of cost cuts.
And we're flying business. Thank you, Bloomberg.
We
do everything.
But what's the balance here, Kweilin, of actually having like an experience that's better? Because not who cares, but it's like, it's one thing to replace people. It's another thing to replace them with, an inferior product.
And I thought all the companies were about customer service, customers first. Not apparently.
And there is absolutely a balance, and there's also a bit of a transition pain point to get there. But I think the alternative is not always great customer service in person. It could be they're understaffed, they don't actually have the people. And so the alternative is, do you want to wait for 10, 15 minutes to flag somebody down to get your order, or do you want to enter it into the iPad? Or do you want to pay $2 more for that sandwich? Or not. And so I think those are the trade-offs that we're really wrestling with.
Well, when does the cost come to us? Because I go to the supermarket and man, I'm doing all the work, or I go to the airport and they're like, you want an extra bag? So when does that cost come back to the customer?
I think we've already started to see it, right, on so many different products. Some of that has been passed along. Some of the costs have been kind of captured and improved, better efficiency and effectiveness, part which has not then been passed on in higher prices, even though supply chains have been challenged and prices across many categories have gone up, most notably in and service and gas areas. I think some of that will flow through over the next few years. We'll see where it all settles out.
Yeah.
But I do think there are automation improvements that are being made, and then, consumers do stand to benefit from some of that.
Hey, really quickly, 30 seconds, because we've got a story coming up about the lack of workers in the healthcare area. You said we are seeing gains in healthcare. 30 seconds. What specifically?
Yeah, frankly, across the board, given consumer spending, aging in the United States, and frankly, in many developed countries around the world. So nursing, tech, and healthcare as well. Overall, I think we'll need quite a few more jobs in those areas.
Well, that certainly fits into the story that we're going to talk about. Kweilin, thank you so much. Kweilin Ellingrud, she is director and senior partner at McKinsey Global Institute on Zoom from Minneapolis. Their latest report, Generative AI and the Future of Work in America. It wasn't so bad in Newark.
Please enter your symptoms on this iPad.
Exactly. Who do I complain to? That's the thing that bothers me. There's no one ever to complain to.
Complain to me, Carol.
All right, I will. This is Bloomberg.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, everybody, safe to say we thought the close was going to be a little bit different, certainly earlier today. We are well off our lows of the session on the equity trade. Still down across the board, Tim, but yeah, like I said, not as bad as it looked earlier today. And yields have definitely bounced a little bit off their low, especially the 2-year. But we're still looking at a 10-year at about 4.01, 2-year note with a yield of 4.75.
Okay, a lot on the agenda, Carol. We got
Yeah.
with today's trade, right? We got the banks. You talked about the move in yields. UPS earnings, not so great. Some pharmaceutical company earnings, those were pretty good. We heard from a couple Fed presidents, one voting, one non-voting. The big question, what does it mean for tomorrow? What does it mean for the rest of the year? What does it mean for the Fed?
I am curious about clarity, and we've got a perfect voice to do it. Understands market cycles, has seen many like us. Sam Stovall is CFRA's Chief Investment Strategist on Zoom on this Tuesday in Allentown, Pennsylvania. Sam, it is good to have you back, and I do really appreciate the way you analyze the market. We all do, and relate it to different cycles. So when you look at this cycle, what matters in a day where we feel like we had a dump of news on China and Italy, U.S. banks, a lot of stuff going on? What matters?
Well, I think a lot of that stuff matters, Carol, but good to talk to you and Tim today.
Yeah.
I think investors have been getting the feeling that maybe we've gone a little bit too far with the market advance. The S&P is up 28% since the October 12th low. The NASDAQ was up 46% through the end of July. And being a reader of the Stock Traders Almanac and doing my own research, realizing that August is the third worst month of the year, second worst for the NASDAQ, but then we have September, which is the worst of the year for both indices, just from a seasonal perspective. Maybe we are entering into a digestion phase because, let's face it, the NASDAQ was trading at 26% above its 200-day moving average, which is a statistical extreme.
So you're saying this is more about seasonality and technicals than actual fundamentals?
I wouldn't go that far because when you look to the fundamentals, you're seeing, yes, the second quarter earnings did come in a little bit better than expected, meaning they fell a little less than was anticipated. 9 of the 11 sectors are actually showing an improvement in what will probably end up being the conclusion for the second quarter versus their June 30th estimates. And when you look to 2024, we're still focusing on about a 12% year-on-year rise for the S&P 500. So should we finally get the last rate hike, I think investors will be feeling good because we tend to see a hike, skip, and a jump that takes place after the Fed is finally finished.
What about, Sam, about the impact of potentially, it seems like the one narrative that feels fairly consistent is higher for longer from the Fed, so that even if they stop raising rates, they're going to keep them there for a while. What's the longer term impact of that on the equity trade?
Well, I think you're absolutely right that normally there is a 9-month differential between the last rate hike and the first rate cut. And the market traditionally has risen about 13%, along with all sizes, styles, sectors, and 99% of the sub-industries. But if the Fed decides to keep rates elevated for longer, I think they will be doing so if we do not end up falling into recession, and if we do end up with a soft landing, which is exactly what they would be hoping for, because the higher rates would ensure that we would end up with a decline in the core PCE that will likely stick around rather than simply touch the low point and then bounce once again. So I would tend to say that the Fed would be very happy to keep rates higher for longer. But if we don't end up getting thrown into recession, that would be icing on the cake, because if we did fall into recession, the Fed would have to reverse course and start to cut.
But is it more likely that we fall into recession if we keep higher for longer? Or will investors see that like, okay, we're done. We're just kind of marking time until the Fed feels comfortable enough to start cutting rates?
Well, I think actually you could say yes to both of those partial questions. First off, if the Fed does raise rates for longer, then it increases the likelihood of recession. But at the same time, if the investors realize that the Fed will be cutting interest rates, then that could be a reason that the recession might end up being shallower than anticipated. I mean, when we look to all of the other historical reference points, we should be in recession by now. Whenever inflation has been above 6%, we've fallen into recession. Year-on-year declines in leading economic indicators have signaled recession. Earnings recessions have signaled economic recessions, and so forth. So basically, this would be one of the few times in which a majority of the fairly reliable indicators did not work.
So it raises the question. Well, actually, I want to go back to something that you said that I've been thinking about. A hike, skip, and a jump. That's what you said, right?
Yes.
So we've had the hike, we've had a skip, but we had another hike. Were you anticipating? So where does the hike? Where does this end, in your opinion?
We think it ends in September. They will hike rates one more time, and then they will be on hold until 2024. Our expectation right now is that they probably will start to cut rates by the end of the first quarter or into the second quarter, and then gradually do so maybe 2 or 3 times next year. But that certainly is dependent upon the data. Maybe we do end up staying higher for longer. But even when we have had a hike, a skip, we've had the jump in the markets, even with a subsequent hike in interest rates, the market continues to rise primarily because they realize that the end is near. The end of the hiking process is almost over.
So Sam, I want to go back to what you said. You know, you talked about earnings recession usually precedes an economic recession. There are other indicators out there that all point to that we're going to get into a recession. And then you kind of said, but this could be potentially one of those times when the regular signals don't bear out. Do you actually believe it could be different this time around? And forgive me, I've only got about 35 seconds left.
Okay, I hate to say this time is different. I do think that maybe we do end up with a recession, but it ends up materializing in 2024 rather than when most people had been anticipating it to occur in the second half of this year.
Okay, so in case we get there, but just different in terms of timing.
I think so. Add to that all of the plethora of inverted yield curves, and the weight of a potential recession is overwhelming.
All right, cool. Great. Oh my God. So glad we got some time with you. Sam, be well. Sam Stovall, Chief Investment Strategist over at CFRA, joining us on Zoom in Allentown, Pennsylvania.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.